Hello everyone, my name is Nicholas Pewson. This is Vincent Rosemelia, Brandon Kurt, and Trevor Legret, and we are pitching a hold on the Coca-Cola Company. Founded in 1886, the Coca-Cola Company has evolved to become a total beverage company that operates in over 200 countries around the globe. There are three main reasons why we're pitching a hold. The first reason, we believe Coke is in a prime position to capture emerging market growth. The second, we believe Coke will face challenges in developed markets. And the third, we believe Coke can leverage their superior management and marketing skills to create returns for shareholders. Trevor, what exactly does Coke do?
Thanks, Nick. Coca-Cola has 6 operating segments: 4 geographic, North America, Latin America, EMEA, and Asia Pacific. The remaining 2 are the Bottling Investment Group and Global Ventures, which perform mergers and acquisitions to strategically hedge and diversify Coca-Cola's beverage portfolio. Coca-Cola's successful corporate strategy has led to high credit ratings and the company being ranked #1 most recognizable brand among the beverages industry. A recent strategic initiative to refranchise bottlers has allowed Coke to reallocate resources to their beverage portfolio. With over 500 brands and 4,000 products, Coca-Cola maintains the #1 share of retail value among the beverages industry. Our strategic initiative to acquire Costa Coffee has expanded Coca-Cola's coffee and tea footprint, while the new release of Coke Energy has continued Coke's mission to become a total beverage company. The beverages industry is very concentrated. Coca-Cola's Global Ventures division strategically decreases the threat of new entrants, while Coke's world-class supply chain decreases supplier power. However, everybody in this industry faces low pricing power. A tale of 2 markets. In developing economies, population growth is high, while in developed economies, population growth is dismal. This is reflected by the unit case volumes and their respective segments. Nick, can you continue this story?
Sure thing, Trevor. Growth, a tale of 2 markets. Why is demand for Coca-Cola products in developing markets so high? The main reason, increasing calorie consumption. People in developing markets are eating more. Why are they eating more? Because they have rising disposable incomes. Global trade liberalization allows Coca-Cola to more easily penetrate these developing markets, while higher urbanization rates improves logistics across these regions for Coca-Cola. In the upper left-hand corner, you can see in red the developing unit case volume sales for Coca-Cola, and in orange, the developed market unit case volume sales. We believe the unit case volume sales are directly correlated with global GDP growth rates. In developing regions, which have higher GDP growth rates, ranging from 2.4% to 6.1% across Latin America, Africa, and developing Asia. The opposite story is true in developed markets. Lower and stagnant unit case volume sales are driven by lower GDP growth rates, ranging from 0.5% to 1.9% in the Japan, the Euro, and the US markets. Again, we believe unit case volume sales are directly correlated with GDP growth rates. Financial analysis, debt. The key thing to look at on this slide is that 96% of Coca-Cola's long and short-term debt is held in fixed bonds. We wanted to stimulate what a 100 basis point interest rate hike would do to Coca-Cola's debt, and we found this would reduce the fair value of their debt by $1.68 billion. Profitability. Coke remains a highly profitable company, with net income having a CAGR of 6.5% over the last few years, and revenue having a CAGR of 1%. This is because Coca-Cola is able to cut costs with their franchising programs and drive growth. Because Coca-Cola has independent bottlers, their margins are significantly higher than the competitors. The key thing to note on this slide is the year 2017. In 2017, Coca-Cola had to pay a one-time offshore tax on their earnings due to a change in US tax code. Shareholder return. Coke drives return for its shareholders in 3 main ways. The first way, increasing share price. The second way, a growing and rising dividend. And the third way, Coke's share buyback program. The important year to look at on this slide is 2018. In 2018, there was a large boost to leverage and ROE. We believe this is because of a $2 billion foreign currency translation adjustment due to a strong US dollar, which artificially caused equity to decline, boosting ROE and leverage. Vinny, Can you pop the top on some of our valuations?
Thanks, Nick. I'll definitely try. For our valuation spread, we decided to use 3 different valuation models: a comparable company analysis, which we weighted 30%, a DDM, which we weighted 30%, and a DCF, which we weighted 40%. Calculating a weighted average intrinsic value, we came up with $56.07, or roughly a 0.97% upside from current price. Looking at our 3.2% terminal growth rate, this was calculated by taking the weighted average of developing and developed markets' projected GDP growth according to the IMF. For our comparable company analysis, the main thing to take away here is that Coca-Cola is trading at roughly a 7.75 premium according to their peers. Looking at the DCF, we used unlevered free cash flow, which we derived from unit case volume sales, and then we projected that unlevered free cash flow out into the future, discounted it back to present day dollars. It came up with a base case scenario of $58.99, or roughly a 6.24% upside potential. And finally, for our DDM, we decided we were going to use a 5-year compound annual dividend growth rate of 5.04% as opposed to a 20-year compound annual dividend growth rate of 8%, because we do not believe that 8% is sustainable for Coca-Cola to continue to increase their dividends by year over year. Doing so, we calculated a base case of $57.01, or roughly a 2.67% upside from current price. Finally, for our operating cash flow, Coca-Cola allocates their operating cash flow into 3 different segments, with most important being dividends, followed by capital expenditures, and then into the share buyback program. This can be seen in 2018. Due to a compressed operating free cash flow, Coca-Cola had to scale back their share buyback program. Brandon, can you touch a little bit on some investment risk?
Yes, thank you, Vinny. I'd like to dive a little deeper into Coke's risk environment. Our risk matrix here shows the potential impacts and probabilities of the drivers that we've identified, with competitor risk being amongst the highest impact and highest probability, particularly in developed markets. On the systemic side of the industry, health and foreign exchange are at the foremost of Coke's thoughts. From 2017 to 2018, Coke more than doubled their foreign currency contracts, which shows a strong initiative to hedge their international business. To hedge their supply chain and labor relations, Coke rolled out a refranchising of bottling operations program, which, since 2017, has been increasing the margin between the bottling investment total employees and the lost time incidence rate, which has further added efficiency into the workplace. Along with this refranchising program, Coke has been reducing their total amount of employees, which we've seen has reduced their pension plan liabilities and obligations. Although faced with complex risks, Coke has a strong corporate governance and a well-diversified and independent board of directors looking to mitigate these types of risks. In 2020, Coke announced intent to buy back 150 million shares, which we see will add value right back to the shareholders. Coke also has a keen eye on the environment, which we can see from their World Without Waste campaign that they launched. Nick, would you bring home our final points?
Sure thing, Brandon. As of January 9th, Coca-Cola had a share price of $55.53. Our target price is $56.07, representing a 0.97% upside. The dividend yield for Coke at this time was 3.07. There are 3 main reasons why we're pitching to hold. The first, the positives. Coca-Cola, it has innovation in developed markets, and in developing markets, they're in a prime position to capture emerging market growth, rising disposable incomes, and increasing calorie consumptions, along with mergers and acquisitions such as Costa Coffee. Our neutral, our valuations. We find Coca-Cola to be fairly valued. And last but not least, the negatives. We believe Coke will face near challenges in developed markets due to low volume growth, changing consumer trends, health trends, and fierce competition. Thank you for your time, and are there any questions?
Yes, I have a question.
Yes.
So how do you think sustainability affects Coke's business? Are there any concerns there?
So their World Without Waste program has really shown some initiatives by Coke. As them being known as more of a polluter, they've really addressed that issue. One of their issues heading into 2020 was they wanted to cut carbon emissions by 25%. Another initiative of that program is by 2030 to recycle a bottle for every single bottle that they sell. So they have a keen eye on that with sustainability, and that's really been improving their margins. People in the US with healthy consumer trends in other countries have been behind that product.
They're also reducing the PET that in their bottles. A new technology called Plasmax reduces the amount of PET by spraying a layer of silicon oxide in the inside to maintain the bottle's sealing ability. So they are making material steps to arrive at these goals.
Okay. Are there any near-term or any of the current issues that are going on right now that impact your either target price or your rating on the company? Or
I can answer that question. So one thing that's been in the news recently is the coronavirus. So the coronavirus has been a viral outbreak in China. 9 to 10% of Coca-Cola's unit case volume sales are in China. And Coca-Cola lowered their guidance for the first quarter of this year by, I believe, 2 cents due to the coronavirus, but they foresee no long-term impacts for 2020 and into the future. So we compared the coronavirus to the 2003 SARS virus outbreak that happened in China to kind of get a similar feel for what happened to Coca-Cola. And so during the SARS viral outbreak, Coca-Cola saw no long-term impacts. If the coronavirus does get worse and becomes a large global pandemic, it could possibly affect our Dcf valuations. But currently, we see no long-term impacts from the coronavirus, and Coke still has some of their operations going in China due to the fact that they're a consumer staples company, and the products they provide, people normally use that to drink every day.
One thing you also noted on is what could potentially make this a buy. Right now, as of when we calculated our price, it was January 9th, and we viewed that, according to our valuations, to be fairly valued. However, if, as Nick said, coronavirus were to get worse, maybe we entered into more of a downside of the world market, we could potentially see Coca-Cola drop to about a price of $50, which we would deem a good buy rating.
Tell me, is Coke expanding or shrinking its share base? You talked about share repurchase and other issues. How's that going to affect your analysis?
So Coca-Cola has historically always had strong share buyback programs. In 2020, they announced again that they're buying back 150 million shares. Typically, they always have a net buyback. However, in 2018, they had a net issuance due to cash flow constraints. So we forecasted in our models all the current buyback programs announced and subtracted them from the shares outstanding, and that's the number that we divided all of our models by.
So it's a net shrink or a net grow?
Of the shares?
Or stable, yeah.
Net shrink.
Okay, thanks.
One of your slides talked about revenue growth at a little over 1%, whereas earnings were growing at close to 6.5%, 7%. What levers do they have to maintain that, and is it sustainable?
Or do you want to answer that?
I can address that. A big reason that their net income has been growing so dramatically as compared to their revenue is due to their bottling refranchising plan. Nick, can you go to the refranchising plan for me? Essentially what Coca-Cola did, and this is something that their competitors are not doing, is they're franchising all of their bottlers out, and so instead of it being internal for Coca-Cola, they're now different companies that are vying for Coca-Cola's business, so they're all competing against each other. And so in order to get Coca-Cola's large contracts, they're trying to see how low can we produce a bottle, how much can we can for, or how low of a price can we can for. And so obviously the lower the price is, that's who Coke's going to take their business to. And looking at our map up here, in 2013, Coca-Cola was the one who managed all these bottling operations. However, in 2017, you can see each one of these are broken into different districts. So let's just say Texas wanted to expand into Kansas, for instance. They would have to buy rights from the bottling group in Kansas to now be able to bottle and sell in that district. So that helps them, those who are very effective at cutting their costs and make it cheaper for Coca-Cola down the line are the ones who are going to grow. So it's a little bit of internal competition for them.
Oh, to add on to the little quantitative for that, bottling operations generate 5 times as much revenue as just the syrup and concentrate operations. And since they're scaling back the bottling operations, revenues are being reduced, but net income is rising because they're improving their margins.
You talked about pricing power a little bit. So with the bottlers now controlled independently, who actually sets price, or how do they influence price in North America, for example?
Well, management has stated in the past that they're going to price their products in line with inflation. So this gives me the intuition that they do have low pricing power. However, the new division, Global Ventures, we see that 5% of revenues between 2018 and 2019 have been associated with price, product, and geography. So I believe that the total portfolio must have pricing power because they're releasing products with higher demand. So that's my answer. Thank you.
Go ahead.
May I just ask a question about your discounted cash flow assumptions?
Absolutely.
Just wondering if you would take a moment to walk us through the assumptions you use, the inputs, and whether you believe those are realistic and achievable,
Absolutely.
and why.
Can you go to our assumptions page, Nick?
Sure thing.
Okay. So we decided that, as I mentioned before, for our terminal growth rate, it's going to be based on GDP projections in both developing and developed markets. So that is something that we see subject to change, especially if coronavirus is a world pandemic. So that is a number that when it came to our DCF valuation, we sensitized. Nick, if you could jump to the sensitization slide for the DCF. So this is where you can see it. Again, assuming we hold WACC constant, but let's say the coronavirus or any other world event drops GDP projections by about 10%, we could expect our price to be sitting at $51.31, which is why I mentioned earlier we still see $50 if Coca-Cola were to drop to that, as still being fairly valued or a buy. Can you go back to the assumptions page for me, Nick?
Sure thing.
And that was based on a 10% change in projection. So for our cost of equity, or that one doesn't affect it, I'm sorry. For our cost of debt, Nick, can you go into a little bit of detail as to how we calculated that one?
Yeah, sure thing. So for our cost of debt, we looked at all the bonds Coca-Cola has issued and their weighting. So primarily they issue in U.S. markets, but recently they've been issuing in Euro markets due to a very low interest rate environment. And we took the average yield of these bonds and weighted it to get our average cost of debt of 1.8. And we believe this cost of debt is sustainable. Interest rates are incredibly low right now, and we don't foresee any hike happening. In fact, the Fed recently announced there is a probability of a cut, and with 30% of Coca-Cola's debt expiring in the next 3 years, it could be a great refinancing opportunity at even lower cost.
And one final thing to note about the sensitivity that we pulled up, that was based on terminal growth rate in the WACC. But in our actual DCF that was in the presentation, we sensitized what would happen if unit case volume sales were to drop by 10% or increase by 10%. So we believe that to be a more realistic manner, that due to some sort of world event, unit case volume sales could potentially drop.
And how about expected market return? You have 10.05%. Do you believe that's achievable, and why?
I do believe that's achievable just because looking at what the market has returned over the years, it's been on average around 10%. So, and then that's what we use to actually come up with our equity risk premium. We essentially took our expected market return, we subtract out the risk-free rate, and then we multiplied that by our beta that we calculated and came up with 5.97.
Also, and if you look into developed markets, they have about 21% share in the cold beverage market. In the developing markets, they only have 11% of the cold beverage share, which the developing markets make up about 80% of the global population, which we see a huge opportunity for them to be able to rise those margins with the market share.
I think I saw. Did I see?
I think we're out of time for questions.
Oh, afterwards,
Find
you
us
can answer the
afterwards,
questions.
Thank you.
You can meet up with us. Thank you guys for your time, and we enjoyed presenting for you.
Thank you very much.
Thank you.